Hey guys, good morning and welcome to your money market update. So do you think that Abby will mind if we've taken her car again? She's overseas. She doesn't even know. All right, so what has been going on in financial markets this week? It has been a big week, all centered around the US Federal Reserve. Can you believe it? The S&P 500 this time last week was down about 14%, and it rallied 6.1% in the past week. The NASDAQ was down 23%. It was rising and closed up 8.1% for the week. It all started around about Tuesday after a market sell-off on Monday. And what we've seen is the market turn around and get all of this confidence and clarity from the US Federal Reserve, which I mentioned last week that was going to be really important for the market. The Fed was going to raise interest rates. It's confirmed that. It stopped the stimulus. It confirmed that a month or two ago. But what the Fed did was basically put a floor under markets by telling investors exactly what it's going to do for the coming 6 months. Now, there's about 6 Fed meetings between now and the end of the year. They've basically said they're going to raise rates at every meeting. And the market is now aligned with the Fed with respect to inflation, what the expectation is there, what is with interest rates. So what the confidence that the market now has all come about because of the clarity. Any surface down there this morning? She's a little blown out today, but the market now has some clarity around what is going to happen with regarding interest rates, and also the fact that the market is starting to buy into the fact that a recession in the United States is much, much less than a 50% probability. So essentially all of this money that's been sitting on the sidelines that came out of the market in sort of about the second week of January onwards is now starting to come back into the market. Now, I'm not suggesting that markets can't go back lower, because I still think that next inflation report in the US is even going to be higher than last month's inflation report. I mean, you can't have oil go to 120, 125 and touch 130, back down to 95, back up over $100 a barrel, and that not impact inflation negatively with respect to it going up. So I still suspect that the market's got some hurdles to get over with regarding inflation numbers in the next few weeks. But certainly, well, the S&P is not even in a correction anymore. The NASDAQ is still in a correction, but it's no longer in a bear market for the time being. So at the moment, it's happy days. Now, there is one industry sector that did really well this week outside of tech. The tech sector, as I said, was up 8.1%. In case you're wondering why we're in the car, if you come to Noosa, and did I say that like they say it on that TV show, Kath and Kim? Noosa. If you come to Noosa, and you don't go to Flo's for breakfast, where we're going right now, you're doing yourself a disservice. You've got to go to Flo's. It's the best brekkie in Noosa, as you're about to see in a moment. Now, banks were rallying very strongly this week. Why were banks rallying strongly, and why should you have a really good quality bank in your portfolio for the next couple of years? The reason being is because interest rates going higher, margins at banks, profit at banks swell. They get bigger and bigger and bigger as interest rates go higher. Their margins. And what drives share prices higher? Profits. So banks were doing really well this week. Got to make sure you have a good quality bank in your portfolio. And the other reason why banks were doing well is because the recession fears that the market has are starting to dissipate. So what we're seeing now is interest rates go up, banks are rising, inflation fears may subside somewhat in the second half of the year, but the recession fears are basically off the table for now. So banks did really well this week, and our investments in the banks that we bought back in 2020 are now up around about 90 to 100% return. So we're close to a wonderful return of nearly a multi-bagger return on our banks. Now, interesting enough, I touched on it last week. Buffett was continuing to buy Oxy shares all through this week again. He's now got a stake of 14.1% in Oxy. So be interested to see whether he stops there or whether he continues on. But right now, the market is hot. The market is positive. It's always great to get up on a Saturday and see the market so positive. So we're going to go to Flows. We're going to celebrate with a beautiful brekkie with some crepes, maybe a bit of a coffee. I hope you have a great weekend. And I'm hungry. Let's get to Flows. Oh, that was so good. Remember? Flows in the junction in Noosa. All right, let's get home and share with you this week's trading tip. So every week here in the Mooney Market Update, if you want to have your account be like a cash cow, then you're going to make sure that you don't take any notice of geopolitical events long-term, political persuasion with respect to who's running the country. Is it a Republican? Is it a Democrat? Is it a Liberal? Is it a Labor? Who's potentially going to be in government in the next 12 months? What are interest rates going to do? And start to make your decisions around these types of things. Because I can tell you, when we look back at history, in the United States, for example, and it wouldn't be much similar here in Australia, because after 6 or 9 years, the Prime Minister gets the flick here and people want to change. In the United States, there's basically been exactly the same number of Republican presidents as Democratic presidents. In the 1920s, the Dow Jones was 85 points. And today, the Dow Jones closed this morning at a new, I'm getting old now, so I've got to put my glasses on, a new, not record high, but we've seen another high in financial markets this morning. Dow rallied 270 points to trade and close at 34,700. Now that goes to show that it makes no difference to who's running the country. No difference to what happens with interest rates. And what you've got to do is just focus on great quality companies. Forget about trying to time the market and worry about whether or not market's up, market's down, maybe interest rates will be up, maybe inflation is up. We put a ton of money to work on Monday this week. Myself and my clients bought shares in companies on Monday because the NASDAQ was down 23%, the S&P was down 14%. Great quality companies were on sale. Those positions are up 5 or 6% already. Now that's not to say the market couldn't go back lower. But what I'm saying is great investing is very simple. Focus on the simple things that are going to see you get the most success. Buy great quality businesses, buy them at a discount, sit on your backside. So, what's coming up in the market this week? Let's get to that right now. Okay, so what's coming up this week? Last week I said that the Fed decision was going to be the big market mover last week. We nailed that one. This week we are going to see on Wednesday, so there's nothing on Monday and Tuesday that's really market moving. Wednesday we're going to have UK inflation. That's obviously going to be important for the UK, but don't forget, I just mentioned a little while ago that the Bank of England put interest rates up, so I don't expect that to be a big market mover. Thursday, we'll get the NATO summit. Now, this is not an economic data number, but Joe Biden is going to be in Belgium for this event. And this is likely going to be something the market's really going to be keen to hear about, how the NATO nations are going to bind together, pardon the pun, bind together, biding, and decide on what they're going to do next with respect to Russia, sanctions, etc. Interesting, market is actually higher right now, quite a bit higher right now than what it was when Ukraine was invaded by Russia. So it just goes to show geopolitical events. I mean, in this case, it's lasted less than 2 weeks and the market is higher. But the one this week the market's likely going to focus on, I think, is durable goods. Now, durable goods in the United States is basically a retail sales number. So durable goods are things that are supposed to last more than 3 years. Furniture, washers, dryers, bigger ticket items, computers, these types of things. Now, if the durable goods number comes out and stronger than the market expects, and Americans are out there buying big ticket items, that's just another tick of approval for the US economy that it's continuing to do well. The US is very well placed right now. I know there's a few fears around regarding inflation, maybe a recession later this year, early next year. To be quite frank with you, that's miles away right now. And that durable goods number later in the week, on Friday, could be the number the market says, you know what, this recession fear is just done. We are going to continue to march forward. So that's going to be on Friday. So not a huge amount of economic data this week. NATO summit, we'll keep an eye on it. Make sure you keep an eye on the things that matter. Don't focus on the things that don't matter. And one in particular that doesn't matter in the very short to medium term is what your profit and loss is saying right now. It's more important what the profit and loss says in the coming 2 to 3 years from now. Keep focusing on companies, guys. Keep focusing on the things that matter, and you'll do just fine. All the very best. I'll see you next week.